it may be just me, but who has not had that thought when they've started their business to think, right, I'm going to be spending some time building up the business. I'm going to be spending time growing the business. I know I've got to put some sweat in to get some equity out of that, but that time will come when I'm actually going to cash it in, sell it on to another buyer, retire, do something else in my life, new challenges, maybe retire to some Caribbean island somewhere. That maybe it's just me. And that's the topic we're going to have today. Not about Caribbean islands, but about that moment that comes in your life, whether it's very early or very late, about selling your business, looking at the main ways that it's actually valued. Think about that wonderful thing called taxation, how it impacts on us. And that's what we're going to cover in today's broadcast. So morning, folks. Thank you very much for joining me this morning to listen to me talking about your business. You're selling your business at some point in the future, if not now. The taxation impacts. My name is Mahmood. I am an accountant in business. I've been running a business for about 25 plus years now. And I'm in my 25 plus years business life, helping business owners strengthen their money mindset, always important. Making profit, absolutely you need to have that in your crosshairs in your business, making profits. On top of that, how to make time or save time, how to take the tedium out of running one's business, and a whole host of other activities. Now, in last week's broadcast, I talked to you about the first things that you need to consider about selling your business. So check out last week's broadcast. I think there's some great content in there for you to have a look at. And that was thinking about what do we do in terms of the steps, thinking about motivation that we have, thinking about the due diligence that we go through, getting rid of those all-important tire kickers, time wasters. There will be people wasting your time when you put your business on the marketplace. And today is going to be dealing with some of the, what I call the harder edge stuff here, about how do we move from that process. And at the beginning, when we engage with our buyer, how do we come up with a figure, a number that represents the value for our business? It will trip into some of the stuff from last week. So I would certainly recommend checking out what we did in last week's broadcast. For those of you coming up onto replay, thank you very much for your company. If you want to stick #replay into the old comments box, I shall pick those comments up as and when they arrive. It also tells me that you're actually out there listening, hopefully getting some great value from this broadcast as well. So that's a really useful thing. If you've given up some of your time this morning, or now I suppose this afternoon, on a wonderfully sunny day not to actually listen to this, thank you very much for your company. We're going to be talking for about half an hour or so on this topic. Now, I'm very much somebody who likes to make sure we talk about what's going to be relevant and practical. I'll be sharing some tips with you as we go through. For those of you, if you're on catch up, if you want to find out some more background information, check out the weekly podcast that I do called I Hate Numbers. It gives you lots of information about issues that arise in your business, issues that you need to get comfortable with. It's not designed for practitioners. It's designed for business owners, entrepreneurs, whatever stage you are in your business cycle, publishing weekly videos. So lots of good content and guides and everything for you to tap into. And all those things are designed to be practical, useful, and help you on your business journeys. That's enough in terms of the introduction. Let's crack on with what we're going to look at as far as today's broadcast is concerned. There are four key components for me, four key themes that I want to cover today. Motivation, and that's the motivation behind the buyer and the seller. So you as the vendor or the seller, and also your buyer. You might be thinking, well, why is that important? I'll explore that certainly on the next slide, but that's key for you to actually get some clarity. The buyer will certainly be asking you, why are you selling? So having that clear in your own mind is really important, but also it has a big influence on the values that you eventually get for your business. Unfortunately, selling your business is not like selling any other product here. There are a parameter, there are a range of values that we can come up with, but also for me, it comes down to the strength and your ability to negotiate with the buyer the value that you actually want for your eventual business. And there are going to be a number of influencing factors that will determine what that final price is. So being clear what your motivation is and understanding why the buyer wants to buy from you will have a big impact on the final values that you arrive at. Not only the values, but how you proceed, how you get your money, what you're going to be selling. So really, it's key to consider that, I would suggest, at the outset. Unfortunately, over the years that I've been involved in selling businesses, supporting the seller, as well as supporting buyers, by the way, then what I've seen is I'm seeing lots of interesting situations where somebody overvalues a business, where somebody undervalues a business, somebody's not quite clear the processes that are involved here. Some businesses I'm aware of, by the way, and I've come across in my time, that have actually closed down without trying to generate some value they may have stored up in their business. So really important. What's for sale? What are you actually selling? Now you might be thinking, well, that's a silly question, Mahmood. Well, we're going to explore not only what is being sold, but there are different mechanisms that exist for, are you selling your company? Are you selling the trade? I make lots of references to companies in this presentation, but bear in mind, if you're a sole trader, if you're a non-company business here, a lot of this, what we're talking about, refers to you, albeit I make lots of references to shares and companies. A business can be a sole trader, a business can be a partnership, a business can also be done through the vehicles of a corporate entity here. We're going to look at the valuation. There are about 10 to 12 different valuation models. I would certainly use a range of these, and you need to adapt them according to your circumstances. And tax will come into the conversation. So I'm going to give you an overview of the general tax considerations. The topic is too wide and too scopeful to actually go through detailed tax rules. And apart from that, I don't want anybody to lose the will to live. So I'm just going to give you a heads up of the main things you need to consider when it comes to taxation. Certainly, tax is an important component, but do not let it wag the dog of the business here. Wag the tail, if that makes better sense. So what are we going to delve into? So if I'm going to bring my ticker tape on where it's going, let's look at the motivation. Now, for me, even though I've described it as selling your business, there's a lot of value in this presentation, in this broadcast, which actually applies to the buyer. So if we think about it, all the considerations that the seller will be reflecting, those elements that go into it is what the buyer can take some good outcomes from. Now, the motivation is, why are you selling? Are you selling perhaps because the business is very protracted, the business is occupying too much of your life, you've decided to recalibrate your life and have a less emphasis on work in the business, you want to offload it? Are you looking at your business as a pension scheme? So you've got to the end, or that end of your first challenge, you want to sell your business, and that's your route out. Is it because you might be what is called a minority shareholder? So you could be a shareholder in a company with other shareholders, and you decide to liquidate, to sell your part of that business and move on, perhaps by mutual consent. Perhaps there's some disharmony with the other directors, the other shareholders, and that's an exit for you. Is it because effectively you can't make the business work and therefore you decide to move on? Has the business got itself into a very problematic financial situation and you want to move on accordingly? So there's a combination of reasons behind that. Now, for the buyer, and there is still an active market, by the way, for people buying businesses, why is the buyer particularly motivated to go out and buy a business? Well, there are many factors that influence them. It may be as part of a growth strategy. It may be they see you as the competition and they wish to cancel that competition out. It may be a legitimate move as part of a distribution channel. It may be somebody who's a startup company and effectively they don't wish to start from ground zero and they wish to access a business that's already established. Now, understanding that motivation, for me, has a very powerful impact on the negotiations. Anybody who tries to tell you, by the way, that buying and selling business is straightforward, you just fill in some documents, off you go, very, 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 that is very much far removed from the actual reality of the situation. What tends to happen is we may go in, for example, with a price, we may go in with an expectation, and depending how well researched you are, how prepared you are, how much you've done your homework, how much evidence you've got to support it, and also the buying team. So whoever's in the buying team, you're actually going to be negotiating. And I would say draw the analogy and the parallel from selling a house. So you may have an idea that what your home is worth. You may value that home. And when you look at potential purchasers, you may be thinking, okay, this is the value that I want. And there's going to be a period of negotiation that operates between the two of you. So is it a seller's market? Is it a buyer's market? How quickly do you want to make that move? Do you need the cash quickly? All those things will have a psychological impact on the parties involved. So let us proceed. So again, if you're just coming on to catch up, by all means, I'd love to hear your comments. Chuck a comment in the comments box, hit or type in #replay, and I'm more than happy to pick up those comments as they come through. Now, the next thing for me to consider, or for us to consider, is what is it you're actually selling? Now, in your business, when you're selling it, fundamentally, are you selling the business what I call piecemeal? So are you selling just parts of the business? Are you selling perhaps some property that you might have building up? Are you selling the whole business as a what's called a going concern? Now, within that, once you define what it is you're actually selling, the next two options are, and this has an influence for the tax liabilities, it has an impact and a connection to the motivation of the buyer, it has an impact on the motivation of the seller. The two main ways that a business is sold is you either sell the business, the trade, the underlying assets, or you sell the shares. Now, let me give you an illustration. Let's assume we have a company called Mahmood Limited, and through that business, I conduct, let's say, a professional service firm, an accounting firm. Now, I wish to move on, have new challenges, and what I do when I negotiate with a buyer, I can say to the buyer, okay, what I'm going to be doing is I'm going to be selling my company, my shares in my company. You can buy them. Now, the issue that I have with that is because it's not a listed company, trying to find a value for it is going to be one of my challenges. But fundamentally, I'm going to be selling the company. So somebody will take over, I sell the shares in my company, and they become the new owner, the new shareholder. That's option one. Now, that may or may not be an attractive option for the buyer. One of the downsides of buying the shares is that the buyer has to exercise what's called more due diligence. Because once you take over the company ownership, you are then legally responsible for everything that's gone on in that company. And if I've been a bit naughty, if I've not kept things up to date, if I've got legal agreements that the company is bound to, the new buyer will take those on. Now, obviously, the buyer should be doing their due diligence, but they take over the responsibilities of financial responsibilities, the legal responsibilities, and any tax responsibilities. They may not want that. However, a buyer may be influenced by thinking, okay, Mahmood, you've got a business here, you've got some losses that you've built up. I think I can do better than you. So therefore, I'd like to use those losses. So therefore, ownership of those shares is really important for me. That's great. It may also be that me as a seller, if I sell the shares in my company, I am likely to get more attractive, potentially tax reliefs. If there's particularly an offset there, which I'll mention at the end. So those are going to be the influencing factors. I'll make a reference to shares, by the way, but remember, you can sell your sole trader business. It won't actually be a shares, but you're selling the business, so that will effectively apply in the first category. Now, the alternative is the seller says, actually, Mahmood, I'm not really interested in the company taking it over. I've got a separate company. I just want to buy the underlying trade of your company. So I want to buy the customer list, the access to markets, the intellectual property that you've built up. So therefore, sell me the business, sell the trade. And what will happen is I'll sell the underlying business. It typically goes into a new empty shell, a new company or an existing one, and therefore that's it. So I'm still left with Mahmood Limited, but there's nothing in there anymore. The business has been sold on. Now, that might be attractive to the buyer because that means they're not exposed to any obligations that I've got in my company. They also can claim some tax reliefs on the assets that they purchased. Now, for me, what's happened now is Mahmood Reza Limited has sold that business. Mahmood Reza Limited hopefully has made a profit on that disposal. The company will pay tax on that disposal, and then I've got to figure out how do I actually get my hands on the money that's left in the company. Therefore, potentially, there's an element of double taxation that's going to exist. So the money goes into the company coffers. I'm then going to think, how do I get my money out of that company? In previous broadcasts, by there's a background, and on podcasts and blogs, I've talked about taking money out of a company. So if you're thinking, okay, what we're referring to, typically salaries, dividends, or benefits, worthwhile checking out those previous podcasts and blogs and videos and reminding yourself on that. So therefore, that's the dilemma. And again, from that perspective, we're going to have to weigh up and think about that really carefully. If you've got a good team assembled of accountants, of lawyers, of specialists, valuers, and all the rest of it, that's going to make the process much more easy. So remember, right at the outset, as we mentioned last week, make sure you've got a good team assembled, make sure you've got a clarity, make sure things are brought up to date, and make sure before you even start negotiating with the buyer that you've got your house in order and you're thinking through what your preferred strategy is, and the buyer likewise will be doing the same. And what I want to move on to now is the factors that influence how much your business is actually worth. Now, I mentioned earlier on about this idea of growth. Now, growth typically occurs in one of two ways, and this will be, by the way, an influencing factor for the values. So when a company grows, there are two main ways that it grows. Number one, it grows what I call organically. So that means you start from scratch, you build up the business over time, you obviously decide the direction your business is going to, you control the pace of marketing, you control the pace of how you interact with that end customer, and typically it follows what's called a bell-shaped curve. In the early stages, customers that you have are relatively low because nobody knows who you are, that trust dimension has not been built up, but your cost base is quite high. So you don't expect to generate a great deal of money or profits or value in the early stages. But eventually, if you stick at it, if you've got a bit of planning behind you, you've got a good product and service, your marketplace will grow. And it's quite normal that for most businesses, they will experience growth over a period of time. That's organic. Now, one of the positive sides is you control it, you go at your own pace. The downside is it's relatively slow. Now, it may be that you don't wish to grow organically, you wish to grow by what's called acquisition. So you may say, well, actually, there's another business out there that's doing similar things to me. What I'm going to do is I'm going to effectively acquire that business. I add it to my stable, my business will grow because I've got a bigger distribution network. So you grow by acquiring other businesses that are in your space. Now, let's look in terms of really the valuation. How do we come up with a number? So what's the pound note figure, the dollar figure that represents how much your business is actually worth? The harsh reality is, guys, is that a business is only worth what somebody is prepared to pay. Now, that might be a statement of the obvious. That might be a statement that you think, well, actually, maybe that's not really saying a great deal, but that's the reality of it. Anybody who says business valuation is just a scientific process, give me a bunch of numbers, I'll key them into a computer or a spreadsheet or something similar, and bang, there goes your number, is sadly deluded and actually just talking garbage as well. We can come up with a range of valuations. Certainly there is an art and a science to valuations. There are about 10 to 12 mechanisms and models that one can adopt. Typically, what I would always do is to come up with what I call a range of values. So the range of values for me is always have your start position. What's the bare minimum value that you can adopt? There are variations on that start point. So if we have a start point and an end point, we have a parameter of values. If we have confidence in how we've arrived at those values, if we can support those values here to reinforce to something how we've arrived at them, because they will typically, as a buyer, most buyers, when they look at a value, the first things they'll be doing is to check the quality of how you've made your projections. They want to do their due diligence to see if those valuations support it. They will have their own idea once they've done their own digging, seen what's going on in your business, once you've let them in through the door. Effectively, but buyers typically will try and force the price down. In any business negotiation, it's quite normal practice that you're going to have an element of negotiation. Somebody offers a value, a price. Somebody says either, yeah, that's fine, I'm happy. They might see a bargain and therefore say, great, I'll buy it for that figure. If they think the business, in their opinion, is overvalued, if they've done their homework, or if they're just trying to drive the price down, which is perfectly natural, then you're going to have some negotiations. So be prepared for that to go on. Again, the stronger your position, the more confidence you have in the figures, the better prepared your business case, the more you understand the motivations, the stronger will be your negotiating position. If you go in there unprepared, if you go in there without any idea of what the valuations are, if you go there with effectively very poor preparation, be prepared for the buyer to either walk away, not take you seriously, or effectively you could run the risk of underselling your business. Now, the start point for me is the bare minimum. You look at your business and you say to yourself, if the business was to be liquidated tomorrow, if I was to have a fire sale, an auction of what I have in the business, what would I actually get those values of any inventory I've got, customers that settle their accounts, I might have some properties, some equipment. What would that get for me as an auction price, a fire value? If I pay off all the debts out of that, there should be a value. That's the bare minimum walkaway number. Now, if time is on your side and you've got a little bit more flexibility and you're not in a great rush, then you might say, actually, if I looked at there, if I took my time and sold those assets, realised those debts, what would they be in what are called market value terms? The figure might be higher. Well, it should be higher. Therefore, those two represent your bare minimum start position. Now, on top of that, what you're then adding, because if somebody's looking to buy your business in part or in whole, then what they're going to be doing is they're going to be paying for a value over the value of those assets. It's what's called goodwill. Because what they're actually buying, they're buying a business that's in existence, a business that's got a good location, got a good staff team, has got a good customer distribution network, has got access to marketplaces, has got maybe some intellectual property that's built up there. There'll be things that you've got going on for you that a business will buy into. Again, that could be an existing business that wants to buy you, or it could be somebody who wants to start their own business, who doesn't want to wait, doesn't want to build up the business from scratch, and actually will access that straight away. Now, the second one, and it's a relatively straightforward, simple way to do it, but it doesn't mean it shouldn't happen, is to actually what's called waiting. Now, if you're, for example, a sole trader or a partnership, you might look at your business drawings. You look at your business drawings, and you might say, actually, if I look at the past 3 years, for example, and I'm going to weigh them. So I'm going to effectively look at the last 3 years worth of profits, multiply the more recent profits by 3, multiply the year before profits by 2, take the year before that, add them all together, divide it by 6, and that will give me, well, divide by 3, I should say, and that will give you an average annual profit figure. Typically, a multiple is applied of 3, and that's how you might get it. You give more emphasis to the more recent figures, and you get less emphasis to the older ones. Now, you can also do that effectively by just looking at profit. So if you're a business, you're looking at a company, you just weight the profit. So you either weight your drawings if you're a sole trader, or weight the profits. More emphasis to the more recent years, less to the older ones. It's a figure. I've seen it happen in practice. I've used that myself occasionally, and that just gives me a range of figures to actually use. Other options that exist, ideally, you can identify a business, which is very difficult, by the way, if you're what I call a non-listed company. You find a business that's similar to you. You look at it, comparability, and you compare yourself to that business. You have to make certain adjustments, and you come up with a valuation. It's used, I've used it myself. More often than not, what somebody's looking to do when they buy you is to think, okay, If I buy that on, you're thinking to yourself as a business owner, okay, here's my profits in my business. I know they can squeeze a bit more margin out of this. I know they can effectively leverage more efficiency. I know that they're actually going to access some things which is going to make the business much bigger. Remember to include those items that you may not be including, things like what's a reasonable salary. What they're going to be working out is what's called a maintainable level of profits. I've used the word earnings here to describe profitability or cash flows. So what is the underlying maintainable cash flow or profits? And again, apply a multiple to that. Lastly, as I said, there are about 10 to 12 mechanisms. I don't want to sort of strain every single one, but let me give you a snapshot into another one. If your business is what's called property based, so typically you run a restaurant, you run a hospitality business, you run effectively a premise, so that's a property-based business, and the property is the core where the trading activity goes, then you can use that to actually generate the level of profits that business would create, and you can work out the earnings on that basis. Sometimes, if you look at, let's say, a restaurant or a public house or a premise that you can rent out, you might look at the rental on that property. Typically, an investor might say, I want to earn a return of X%, and they work out what the investment would be to get them that equivalent rental income. So again, those are different mechanisms that can be adapted. For here, the whole purpose of doing these is to give you an idea what the range of values will be. We'll give you an indication about when you do your housekeeping, making sure your records are up to date, because if you haven't done your housekeeping, if your financial records aren't robust, that's going to be less of a desirable outcome for the buyer. So therefore, make sure those are things. They're going to look at the quality of the earnings. You can't just make numbers up. They're going to want to check how you've arrived at those earnings figures. If they see holes, if they see there's no evidence, if they can't see how you've come up with that robust information, because they're going to argue the toss, then obviously they're going to drive the price down, if not walk away. So remember, the values fit in, come up with a range, different mechanisms adopted, but ultimately it comes down to the strength of the negotiation, and it comes down to the quality of the presentation that you make in your business case. Now, it wouldn't be a topic worth talking about unless we talk about taxation. So let me just flip in a couple of things to consider. Now, this is an extremely broad area. There's lots of considerations to think about, and this resonates also behind your motivation behind selling the business. Certainly, I would recommend there are ways to mitigate tax. There are certainly ways to reduce it, but you need to think about two parties involved. Now, if you sell your shares in a company, then you will be subject to what's called capital gains tax. So let's say, for example, you sell a business for, let's say, £1 million. You built the business up from scratch. Of that £1 million, if that's what you sold the shares for, then that's the capital gain that you've made. You are allowed about 12 grand a year, what's called annual exemption, but effectively you'll then pay capital gains tax on the rest. Now, capital gains tax rates at high level are 28%. You can claim tax relief. It used to be called entrepreneurs relief, by the way. It's no longer called entrepreneurs relief. It's called business asset disposal relief. It doesn't sound as sexy, but effectively, if you sell part or all of your business subject to qualifying conditions being met, which is typically you've got to have the business effectively for at least 2 years, you've got to have at least 5% of the business, then your capital gains tax rate is capped at 10%. So there's obviously a benefit. That's gained now. They've changed the rules. It's quite mean. So you can only have what's called lifetime gains for disposals after April 20 of £1 million. Capital gains tax rate will be capped at 10% on the net gains. If your company makes the disposal, so they sell the business, the company pays corporation tax, currently at the rate of 19%. There are plans to reduce it, but the problem you've got is how do you get that money out of the company? And it comes back to this, do I take it out by dividends? Do I take it out through salary route? Do I take it out by benefits? There's a variety of ways to extract that money, but there's where the double tax relief kicks in. Remember though, it's not a clear-cut shares or business. A buyer may wish to buy the shares because there are losses in your business. If there's losses built up, then they can use those losses potentially as they develop and they improve your business, and therefore for them it's more favorable. So again, think about the reliefs. One other thing to bear in mind, if you've got a business that you're growing, or you've got a business and you've got 2 distinctive or 3 distinctive shapes to it, it's advisable to think about creating a subsidiary for the other businesses, because what can happen, again, subject to qualifying conditions, if you've got a separate limited company which carries out one type of business activity, and you've got another business that's through a different limited company, you may decide after a period of time to sell that limited company. Now, if you meet the qualifying criteria, there is no corporation tax to pay at all when you sell that limited company, brackets your subsidiary. It's called, now this is a bit of a mouthful, substantial shareholding exemption. So again, as all these things in life, get some good competent advice, make sure you plan these things well in advance, and therefore there can be some real good benefits for you when you come to actually make that final disposal. So again, personal and corporate, you've got 2 hats to think about, so think about them carefully. Okay, folks, so what's the next thing we need to think about? Well, having gone through all that, for me, I'm going to just mention here, I publish a weekly podcast called I Hate Numbers. By all means, check it out. The topics we've talked about today and on previous weeks are covered in I Hate Numbers. It's aimed at business owners, it's aimed at entrepreneurs, so it's not a technical podcast as such. Sorry to disappoint all the technical people out there. It has got some value. Have a check it out. If you want to receive additional information, be part of a regular mailing, by all means, drop me a line on clients at Proactive Resolutions. We typically send out a mailing about once a week. You don't have to be a client. We're not going to stalk you. We're not going to hassle you, but there's going to be some good, valuable information. And by all means, check out the website at proactiveresolutions.com. I thank you very much for all your company. If there's any comments or thoughts that are coming out of this broadcast, by all means, share them with me. Hope you all have a fantastic week. I'll see you all again on the Business Growth Club broadcast on Tuesday. And certainly for me, even if you're not at that stage of selling your business, there's a strap line for you. If you grow your business well, your business will have value. Most businesses, not all of them, have values that a buyer will want to access and pay you money for. Certainly worth considering. So apart from that, folks, I'll just wish you a good, speedy Saturday. Have a great week ahead, and I'll catch you all in next week's broadcast. Until then, it's goodbye from me, and I'm going to play you out with a bit of music here just to kickstart you into your Saturday afternoon if you're in the UK. Anywhere else